What is going on, guys? Nick here, back with another video. Now, it is earnings season, and last week we had some big names put out their earnings. Now, for me, I do a lot of research on companies before I make videos on them, but it does become difficult for me to keep up with all the news and the valuations after I put out the video. The reality is, valuations change and prices move, and unless we refresh ourselves regularly, it's hard to keep track of what's expensive and what's not. So in this video, I'm going to look at the big earnings releases for the past week, so how the numbers came in, how the financials look, and how the valuation looks now. So let's get to it. So the first company we're going to take a look at is Microsoft. Now, going into earnings, Microsoft made some pretty big headlines after it announced it was acquiring Activision for $68.7 billion. Microsoft will become the third largest gaming company in revenue behind Tencent and Sony. With this deal, Microsoft will gain control over some of the biggest game series in the world, including Call of Duty, Warcraft, Overwatch, and a bunch of older games. Now, keep in mind that Microsoft did purchase Bethesda Softworks just over a year ago and already purchased Minecraft back in 2014. Now, the Activision deal still has to go through regulatory approval first, and recently there has been a lot more harsh discussion about breaking up big tech, which Microsoft had been escaping, but we're gonna have to see how this plays out. I do expect a fair amount of scrutiny for this deal. It seems like the goal is to compete with Facebook towards the future of the metaverse, and owning more and more gaming platforms and developers probably seems like a smart way to gain an edge in the competition. Satya Nadella, Microsoft CEO, says that he doesn't expect a centralized metaverse. Instead, he thinks there's gonna end up being multiple metaverses, but if you ask me, to be honest, I'm not really that sold on the idea of the metaverse anyway. I do feel like we've seen a lot of physically interactive content come and go from the old Wii, which brought out the Xbox Kinect and the PlayStation Move, and then things like Google Glass. But time and time again, people vote with their money, and it just doesn't seem like consumers really want that fully immersive experience that they're trying to sell you with the metaverse. Maybe something's gonna come along and change my mind, but for now, I'm just not really that sold on the idea of the metaverse succeeding 5 to 10 years from now. Now, Microsoft's earnings came out on January 26th, and the earnings came in at $2.48 versus $2.31 expected, and revenue came in at $51.7 billion versus $50.8 expected. Now, I put together this pretty cool chart showing a full year of earnings for each quarter reported. So quarter 1 22 is actually showing you quarter 1 21 through quarter 1 22. And quarter 2 22 is showing you quarter 2 21 through quarter 2 22. So it's a full year of earnings for each of those bars. So looking at this chart, the red bar is the most recently reported earnings report. So overall, this was a very good quarter for Microsoft. We can see since 2017, Microsoft has shown some pretty incredible earnings growth, going from $3.37 per share in September 2017 to $9.39 earnings per share today. So looking at the current revenue and net income chart, we can see that highlighted again. Not only is revenue quickly growing since 2017, profits are also growing, and on top of that, profit margins have actually gone from 20% to 38% between 2015 and the past year. When we look at revenue versus expenses, we can see why Microsoft is such a profitable company. First, their cost of revenue is pretty low, accounting for only about a third of their revenue. On top of that, they also bring in so much revenue that even after spending $22 billion on research and development over the past year, it's hardly anything in comparison to their $158 billion in revenue that they brought in. On top of that, they still spend $20 billion on sales and marketing, and another $5 billion on general and administrative costs. So again, another $25 billion really just doesn't add up to the $158 billion in revenue that they made. Now, looking at their segments broken down, we can see that they all are performing very well. The largest seems to be the intelligent cloud business, which is their server-related products and obviously cloud services. Productivity and business seems to be the second largest segment, which is made up of Microsoft Office, Teams, LinkedIn, and their other programs and apps. The third segment, which still brought in $21 billion in operational income, is the more personal computing segment. And this segment's made up of the entire Windows operating system licenses, the entire Xbox ecosystem, and devices including the Surface and PC accessories. Now, if we look at the current forecast for Microsoft, right now the current projections are for Microsoft to hit $256 billion in revenue and $93 billion in profits by 2024. When we look at their projected revenue growth going forward, we can see that Microsoft is projected to continue growing around 13 to 18%. Using that as our growth rate to value them, a growth rate of 13% comes out to a fair PE value of 29, and a growth rate of 18% comes out to a fair PE value of 44. Now, when we look over at macro trends, we can see that the PE ratios for Microsoft have been climbing recently. And this, of course, makes sense when we look at their earnings per share from 2006 till today. They basically showed no growth during that time span, so a PE ratio of 7 to 10 was appropriate at the time for them. However, we can also see that over the past couple of years, that PE ratio has been climbing, and it now sits in the low 30s, which is close to what I think the stock should be worth. Now, if we go over to Microsoft's value chart, we can see that Microsoft Microsoft is currently trading towards the low end of its fair value, and by 2024 it has an upside of $362 or 20% higher, and a high-end upside of $549 or 81% higher than the current share price. So Microsoft is definitely cheap if you're looking to buy right now. Okay, so the next stock on this list is Tesla. So Tesla reported its fourth quarter earnings on the 26th, and initially the stock dropped after they said their factories have been running below full capacity for months due to supply chain issues. Tesla is still dealing with chip shortages, which they expect to continue throughout the year. However, Elon said that even with those production concerns, he still sees the production growth growing comfortably above 50% in 2022. Now, some analysts on the call were a little critical of the relatively vague call in regards to its 2022 outlook. There wasn't any announcement that Elon was going to do anything crazy like dig a hole under LA or sell flamethrowers, and on top of that, Tesla did also announce the project to build a $25,000 Tesla is currently on hold because Elon says the company just has too much on its plate right now. It seems like they're mostly focused on continuing to scale production between the factories and focusing on working towards full self-driving. Now, before I go any further, I just want to mention to anybody who's about to freak out over the next 30 seconds that I am not a Tesla bear. I think the company has been mostly fairly valued, and all these people claiming that Tesla is overhyped and overpriced are wrong. Okay, now back to the video. On the call, one of the analysts asked, if there was no $25,000 vehicle, do you think it's realistic for Tesla to sell more than 3 million vehicles with 2 high-volume cars and a Cybertruck in 2024? Now, Elon responded to the question saying, it's apparent from the question that the gravity of full self-driving is not fully appreciated. He expects Tesla's driverless technology should be so advanced that it's going to continue to drive their car sales all the way to 3 million cars without adding other models and adding lower price points. But the unfortunate reality is Tesla, while they have been absolutely crushing vehicle sales, self-driving definitely has been overpromised. In 2016, the company said they would be able to have hands-free trips across the US by 2017, and even now in 2022, that's still not the case. Personally, if I could buy a car that could go places and I wouldn't have to worry about driving, I am all in. I would love to buy that car right now. But right now that doesn't exist, and I'm not fully sure when it will, but I do think it seems a little ambitious to say by 2024 that full self-driving is going to drive Tesla to 3 million car sales. Okay, so when we look at the quarterly earnings report, we can see why Tesla stock has been blowing up recently. The last quarter where they earned $2.52 per share is almost half of what they earned for all of 2021. But the issue for Tesla is stock expectations are obviously very high. So even though they did a really incredible job, there's still some expectation that they'll have to continue to overperform on top of the stock market pullback. When we look at the last 10 years of revenue and profits, we can see that Tesla does have a very strong track record of growth, growing from just $12 billion in revenue in 2018 to $46 billion over the last year. So when we look at Tesla's revenue versus expenses, we can see that just like other car manufacturers, the cost of revenue is obviously the majority of their expenses. Now, I did hear a lot about how Ford and GM sell 2 to 3 million cars while Tesla only sells 1 million. Why does Tesla have a market cap of $840 billion and Ford and GM are only around $70 to $80 billion? Now, the first and most obvious answer is the rate Tesla is growing their sales is so much faster than the other two companies. And another, I think, poorly explained argument is to look at Tesla's profit margins versus Ford and GM. Now, this chart shows Tesla, Ford, and GM's operating margins, so what we have left after the cost to build, research, and sell their products, but before we paid taxes and interest and all the other expenses. Look at the rate that Tesla is increasing its profit margins. Now, I do see that GM is also showing an increase too, but look at GM's revenue and net income chart. And now look at Tesla's. It just seems like GM is probably unlikely to have the same amount of profit margin growth in comparison to Tesla. And Tesla's doing this with only about a third of the car sales of the other two companies, and Tesla's still growing really rapidly. Okay, so when we look at the current forecast for Tesla, we can see the growth is obviously projected to keep on going, with revenue and profits growing from $46 billion and $3.4 billion in profit to $125 billion in revenue and $16 billion in profits by 2024. Looking at revenue growth, we can see that Tesla is expected to maintain over 20% growth going forward. So if we value Tesla between 20% for the low end of the range and 25% for the top end of the range, that gives Tesla a fair PE range of 53 to 80. Now, when we look at their valuation charted out, we can see that Tesla is obviously expensive in comparison to the trailing earnings, and that is basically trading at the projected fair value somewhere between the end of 2022 and 2024, which I would say makes Tesla trading above fair value. It's not extremely expensive where I would say sell everything now, but it's not so cheap that I would start loading up on the position. Okay, so the next one on this list is Apple. So the big question going into this earnings report is how well would Apple be able to deal with the semiconductor shortage and the other supply chain issues. I'm sure we've all heard about how difficult it was to get the new iPhone 13, but when earnings released, Apple reported earning $2.10 versus $1.90 expected and $123 billion in revenue versus $119 expected. Now, when we look at this quarterly earnings chart, we can see exactly why Apple stock has been on fire. Apple's continued to grow profits, with the last quarter alone bringing in more than all of 2016. And keep in mind, this was all while dealing with supply chain constraints. Now, Tim Cook also mentioned on the call that, like Microsoft, Apple was looking to get involved in the metaverse. He didn't really seem to give out specifics, but he did mention that Apple is interested in getting involved, and Apple could potentially use the ARKit apps that are already on the App Store to gain access. Now, I've already let you guys know what I think about the metaverse, so we'll see. However, this does seem like a pretty minimal investment, so I'm not really that concerned. Okay, so looking at the revenue and net income, we can see that there was a little bit of a decline in the post-supercycle year, but the drop was much less than any other post-supercycle year, which again, with supply chain constraints, is pretty impressive. Apple's revenue and expenses show a company whose cost of revenue is around 60% of their revenue, and similar to Microsoft, they make so much revenue that the $23 billion they spend on both research and development and selling and general and administrative expenses is almost nothing in comparison to the amount of money that they bring in. Now, when we look at Apple's revenue broken down by its products, we can see that the iPhone still dominates the revenue generation, and services is actually coming in second with almost $72 billion generated over the last year. But unfortunately, Apple doesn't break out the income generated by each of these products, so we can't see that. However, they do break down all products versus services, which shows us that even though services over the last year only brought in a smaller amount of revenue, they still accounted for about a third of all of the profit. So services is becoming a very big profit generator for Apple, which has been Tim Cook's goal to get away from relying so much on the iPhone. Now, when we look at Apple's forecasted earnings, we can see that they're projected to grow from $365 billion in revenue and $94 billion in profit to $334 billion and $111 billion in profit by 2024. Now, when we look at Apple's revenue growth, it shows them slowing down to only around 5% growth by 2023 and 2024. But looking at this chart, we can see how Apple is very up and down between the supercycle years. However, the down years this year project to grow instead of the typical drop. So if we look at the 5-year average growth rate, we can see that Apple recently has picked up a lot since they started growing the services business, with the last 5 years showing 11% growth annually. If we value Apple using an 8% growth rate for the bottom end and 12% for the top end of the range, that gives us a fair PE value somewhere between 18 and 26. Now, when we look at this valuation charted out, we see that Apple is pretty expensive, with the current price not actually hitting fair value until between 2023 and 2024, which for me puts Apple in the hold range. Not good enough to buy, but not too expensive where you should sell. Okay, so the next company on this list is Robinhood. Now, Robinhood stock has basically fallen since the IPO around $38 per share, which unfortunately is where I bought and recommended buying the stock. Robinhood reported earnings on the 27th, and they reported losing 49 cents per share versus 42 expected. Revenue came in short too, with only 362 million versus 371 million expected. They also saw monthly active users decline from 19.9 million to 17.3 million. So this really wasn't a great earnings report. On top of all that, the company's outlook for the first quarter of 2022 came in much lower than expected. Robinhood is expecting to take in around 370 million in revenue versus the 447 million that analysts had been projecting. So on top of the poor earnings, guidance wasn't great as well. Now, when we look at the full year quarterly earnings report, we can see that the last quarter saw a much smaller loss than what we've seen over the past year from the company. And also during the call, Robinhood says that they expect to become profitable during 2022. Now, when we look at their revenue and net income, we can see the loss they produced over the last year so far is pretty shocking. It's almost double what they took in revenue. So if they were able to turn a profit this year, I would see that as pretty surprising. Now, unfortunately, it is also very annoying that I can't get access to Robinhood's quarterly report because for some reason it's still not uploaded. But when we look over at Robinhood's current forecast going forward, the expectation is for Robinhood to continue growing from $1.7 billion in revenue and a $3.2 billion loss to $3.4 billion in revenue and $335 million in profits by 2024. Now, I do think that Robinhood is going to face a lot of headwinds over the next couple of years. The first big one is, while a lot of people joined the stock market in March of 2022 and January of 2021, it does seem like a little bit of that interest is declining. When you look at this Google Trends chart, you can actually see the pretty big spikes in March 2020 and January 2021. Now, there does seem to be a little bit of a jump recently, and that probably has to do with a lot of the volatility we've seen over the past month. But we've also seen a lot of the fun go away with a lot of the meme stocks and the disruptor growth companies that saw these crazy rises during 2022 and 2021. done, they all seem like they've lost a lot of momentum, and I actually think that drives a lot of the retail investors away from the market who otherwise would be using Robinhood. When the market isn't fun for them, they no longer want to play the game. Now, looking at the current revenue forecast for Robinhood, it's obviously still very high. Personally, I think to value them, we're going to have to use a generic growth rate of 20 to 25% growth. And since they aren't currently profitable yet, we have to estimate their profit margins. So if we go a little lower than the industry average, I think we could reasonably expect Robinhood to have a profit margin between 10 to 15%. So 20% growth and a 10% profit margin gives us a fair price to sales value of 5, and a 25% growth rate with 15% profit margin gives us a fair price to sales ratio of 12. So when we look at this valuation charted out, we can actually see that Robinhood stock is still pretty cheap. But keep in mind that this entire valuation still depends on them executing the current forecasts. Now for me, at this point, I'd rather see how they do a little more going forward, because if they stop losing customers and start to return to growth, this does seem like a pretty cheap stock. But if they can't get that customer base back, then I don't think that the company is worth investing in right now. So Robinhood, I would say, is a hold right now. Okay, so the next company on this list is, of course, Visa. Probably one of the most interesting bits of news to come out of Visa's earnings is they reported customers made $2.5 billion in payments with crypto-linked cards in the first quarter of 2022. Now, these are Visa cards linked to crypto wallets like Coinbase, Circle, and BlockFi. Visa also reported earning $7 billion in revenue for the first time, which came after lower than expected incentive payments, meaning credit card rewards, and higher international performance. They said that payment volume rose by 20%, and most importantly, they saw an increase of 51% in cross-border transactions. Visa also said they currently don't believe the current surge in the pandemic will slow down recovery, and that they see economies around the world continuing to improve. As restrictions are lifted, cross-border travel will continue to recover. The full earnings came in at $1.83 versus $1.70 expected, and revenue came in at $7.1 billion versus $6.8 billion expected. Now, looking at the quarterly trailing 12 months, we can see that this was a pretty significant quarter for them. We can also see the really big bite that the travel restrictions took out of their earnings. Now, looking at the revenue and net income, we can see how the business hasn't been growing like it was in the first half of the decade. However, what we do notice is profit margins are insanely high, around 50% profit margin. Now, when we look at the revenue versus expenses, as we should have expected, they almost have none. They don't even report a cost of revenue category, which is pretty interesting, although network and processing, that purple bar, is probably the closest thing to that. Now, looking at their segment performance, we can see exactly why I've been so high on the stock. While the overall revenue looks very flat and the company appears to not be growing, it's really the loss of international transaction revenue that has caused the revenue to stay flat over the past couple of years. We can see that both service and data processing have continued to grow steadily, so as international transaction revenue fully returns, the company is going to do very well. Now, I valued Visa like 3 times in the past month, so if you want to see how I get to my valuation, check out one of these videos on the screen. Now, for this chart, I'm using a fair PE value between 27 and 42, which puts Visa's current valuation just below fair value by the end of 2022, with Visa having a potential upside of 16% and a high-end upside of 80% by 2024. Okay, so the last stock on this list is GE. Now, I feel like I'm looking at GE just out of morbid curiosity, but if we start by looking at the last 10 years of GE's earnings, we can see a company that is really struggling. They've been profitable just twice between today and 2015. Revenue is continuing to decline, but a lot of that has to do with the turnaround plan being implemented. When Larry Culp took over the business in 2018, the number one goal was to improve the financial position of the company. The focus is on getting rid of businesses that just aren't contributing as much, and then to reduce GE's overall debt situation. The second goal is to work towards improving their financial efficiency, which they expect to achieve through cutting costs and working to improve their services and products. Well, in the last earnings report, GE announced that it did beat the free cash flow expectations, but revenue again did fall short of forecasts, with supply chain issues blamed as the cause. Now, GE has recently changed a lot about their business. Specifically, they will spin off GE Healthcare, but retain about a 20% stake, and GE Power and Energy and Digital will be spun off together in 2024, and the remaining GE company will be focused on aviation. That still leaves a lot of questions about who's getting the debt load, so we're going to have to see how that ends up shaking out. But when we look at how this quarter compares to the rest of their earnings, we can see that this really wasn't a whole lot of profit compared to what they were doing in the past. And since this company is in the middle of a big turnaround plan, I'm not really sure how much it matters anyway. Now, unfortunately, again, like Robinhood, I am still waiting for GE's 10Q to upload, so I am definitely missing a lot of information. However, I was able to find some interesting information anyways. Now, if we look at the segments broken down by the information we have so far, we can see that clearly aviation is the biggest revenue generator, and that healthcare has been surprisingly pretty steady and profitable for them. Now, keep in mind that power, renewable, and healthcare are all going to be spun off, and on top of that, the GE Capital unit is also in the process of closing out and being merged into the rest of their business, which is going to happen after GE sells their aircraft leasing business for $24 billion in cash. So we're looking at the forecasted earnings for GE. The current projections are for them to grow to about $90 billion in revenue and $7 billion in profits. But if we look over at revenue growth, we can see the business has mostly gone sideways. So for fun, let's value them with a -2% growth rate for the bottom end range and 2% growth for the top end of the range. That gives us a fair PE value between 7 and 10. Now, if we look at the valuation chart, this still puts GE fairly expensive with a fair value between 46 and 66 by 2024. The current forward PE ratio by 2024 is 13, so I do think things have to improve a lot for this company to justify the current price of 92 per share. Okay, so that's the update. We covered Microsoft, which does look pretty cheap. We looked at Tesla, which I think is sitting a little bit above fair value. Apple, which is pretty expensive and not the best deal right now. Robinhood, which could be cheap, but I would wait to see how their loss of users shakes out over the next couple of quarters. Visa, which, it's pretty cheap and really starting to recover well. And GE, which honestly is just a giant mess, and I would completely avoid the company. Now, before you go, make sure you check out this great video I have up here for you next. And as always, thanks for watching.